Today, we're talking about something that seems simple, but can quietly become one of the biggest stressors in a relationship, and that's managing a joint account. As a CPA, I've dealt with couples at every stage: dating, engagement, married, with kids, without kids. And I can tell you this: money problems in a relationship are rarely about math. They're about communications, expectations, and structures. Welcome back to the channel. I'm Joe, a licensed certified public accountant with over 10 years' experience in corporate and public accounting. I have an extensive background in accounting, audits, and taxes, and I'm all about helping you take control of your money and live smarter. Be sure to subscribe to the YouTube channel and turn on all notifications. And check out the blog site where we post every Monday, Wednesday, and Friday. So if you're thinking about opening a joint account or you already have one and want to make sure you're doing it right, this video is for you. Let's walk through how to manage a joint bank account the smart way without damaging your relationship. Before you open that joint account, you need to answer this one simple question. And that question is, why are we doing this? Why are you opening this joint account? Is it for paying a rent or mortgage, covering utilities and groceries, saving for a house, managing childcare? Maybe you're trying to combine everything fully. Not every couple needs to combine 100% of their money. In fact, one of the healthiest systems I see is what I call the yours, mine's, and ours model. You keep individual accounts for personal spending. You open one joint account strictly for shared expenses. That structure alone prevents a lot of unnecessary tension. The goal isn't to merge identities, it's to manage shared responsibilities. Now, let's talk about contributions, because this is where things get emotional quickly. There's three main reasons there's three main ways couples contribute to a joint account. You have the yours, mine's, and ours, which I recommend for most couples. As I explained a little earlier, this is where individual accounts are for personal spending and they have a joint account for those shared expenses. You have the 50-50 split. This is where each person deposits the same dollar amount. This works well if incomes are similar. And then you have the proportional split. This is where each person contributes based on their income percentage. So if one partner earns 60% of the total household income, they cover 60% of the joint expenses. As a CPA, this is usually what I recommend when incomes differ. It feels fair, it reduces resentment, it creates balance. And then you have the all in approach. This is where both paychecks go into one account. All expenses come from that account. This requires a strong alignment, high trust, and very similar financial values. There's no universal right answer, but there is a wrong one: not having a clear agreement. So let's talk a little bit more into determining the contributions. So, one of the key considerations is checking what is the income difference between you and your partner. What are the debt obligations? Maybe you have student loans and your partner doesn't, or maybe you don't have, you're debt free, but your partner may have some credit card or outstanding loans. What are your combined financial goals? And then what are your lifestyle expectations? Just to give you a personal tidbit, my wife, when we have a difference in the way we shop at the market. Me personally, I like buying the store brand. She likes to buy the national brand. But we usually compromise on when we will get store brand and when we'll get the national brand. So as we go back to that proportional example, if partner A earns 60% of the total income, then partner A will contribute 6% towards that joint account. This is a focus on fairness, not equality. Here's something that couples rarely talk about up front, and that they really talk about is setting spending rules. And what amount requires a conversation? That's something you have to speak about with your significant other. Is it $100, $300? Maybe it's $1,000. Because technically, with a joint account, either person can withdraw everything. That's a lot of power, and without boundaries, it creates anxiety. Set simple guidelines. Agree on a spending threshold that requires discussions. Decide whether gifts for each other come from a personal or joint funds. Clarify what counts as shared versus personal. These conversations may feel awkward. Have them away. It's much easier to define expectations than to repair broken trust. Just to give you another example, I'll use me and my wife because we've been together for quite some time now. When we first opened up our joint account, uh, I felt like it was okay to spend from the joint account for our groceries. She thought that it should come from her personal accounts. So we had to agree on whether setting those boundaries for whether groceries should come from our personal or from our joint account. Just make sure you have the conversation. Trust me, it saves a lot of headaches. Next, we're going to talk about both partners being transparent. This is non negotiable. Remember, both partners should have full online access. They should both be able to see all transactions that are coming in and out of the joint account. They both should know the bill schedule, and they both need to be aware of what the current balances are. No one should feel in the dark. I always recommend a monthly money meeting. It doesn't have to be formal. Grab a coffee, sit down for 20 minutes, and review spending, upcoming bills, saving progress, and any stress points. Small, consistent check ins prevent big blowups. One thing me and my wife noticed managing our joint account was that our mortgage had went up due to our property taxes going up. So we had to sit down and talk about how we're going to make the adjustments and where we're going to make up the extra money. And even with our gas bill here in Philadelphia in the winter, it usually triples compared to in the summers. So we have to figure out a way of how to manage uh, that predictable but unpredictable increase in our gas bill during the winter months versus the summer months. Remember, transparency is not negotiable. This is the point where most couples tune out, but this is probably one of the most important parts of this whole program. Most joint account most joint accounts are set up as joint tenant with right of survivorship. That means either person can legally withdraw funds. If one partner passes away, the other automatically inherits the account balances. That has estate planning implications. Also, understand that creditors may pursue joint funds for either party's debt. In a breakup or divorce, funds may not be split the way you assume. If you're unmarried, this is especially important. A joint account creates shared access, but not necessarily shared legal protections. Know what you're signing. A joint checking account is one thing, but joint debt, that's something totally different. Just remember, before you co sign a loan, open a joint credit card, financing a vehicle together, understand this. Both both credit scores are tied to that debt. If one person misses a payment, both credit reports suffer. I generally advise couples to move slowly with joint debt, especially before marriage. Shared cash flows is manageable. Shared liabilities is long term. This may seem counterintuitive, but maintaining some financial independency actually strengthens relationships. Each partner in the relationship should have personal spending money, maintain some sort of individual savings account, and they should also know how to access funds independently. This isn't about planning for failure, it's about stability. When both people feel secure individually, they contribute more confidently to the partnership. Financial autonomy reduces fear, and fear is what often fuels money conflicts. Okay, so now here's the truth. Money arguments aren't about dollars, they're about values. One partner might prioritize investing aggressively, building retirement early, and paying off debt fast. The other might prioritize lifestyle upgrades, travel, helping family financially. Neither is automatically wrong. But if you don't discuss these philosophies, your joint account becomes a battlefield. Have the bigger conversation. What does financial security mean to us? What are our long term goals? How do we define success? How much debt is acceptable? Alignment matters more than income. Automation removes emotions from execution. Direct deposit contributions, automatic bill pay, instead of recurring transfers to savings. The fewer the manual steps required, the fewer the opportunities for tension or oversight. Consistency builds trust. A joint bank account isn't just a financial tool. It's a relationship structure. When managed well, it builds teamwork, transparency, accountability, and shared moments. When managed poorly, it creates silent stress that builds over time. Focus on clarity, fairness, communication, and structure. You don't need identical incomes. You don't need identical spending habits, but you do need a system that feels respectful and sustainable for the both of you. If you found this video helpful, please hit the like button and subscribe for more money management tips. And join me next week where we'll talk about budgeting during life transitions.